Afternoon. I want to thank everyone for joining us today as we talk about managing taxes through retirement. I'm Lindsey McKay, owner and lead advisor at McKay Wealth Management. We do a lot of planning with our clients, and taxes is an important part of that conversation. So, what we're going to talk about today is just sort of the pieces of life that can happen during retirement that can trigger some additional taxes, how we can plan for that, and really just be mindful of how the different pieces of our retirement plan will work together from a tax planning standpoint. Some of the pieces that we're going to talk about today are going to be 2022 tax planning because a lot of clients are just getting to that phase now. I do want to make sure to note that. So everything changes every year from an IRS standpoint. So I did put in the chat box a piece that we share with our clients, which is our key financial data. This is our 2023 piece. A digital copy is available for you to access through chat. If you want to have a hard copy, I'd be happy to send one to you if you let myself or a member of the team know. And again, when we're going through the presentation, I'll really work to call out what is 2022 numbers versus 2023. But that's really a key part of all of these tax challenges is that those numbers do differ on an annual basis. So it's so important that we're reviewing it annually, whether you're working with a professional CPA, doing your taxes yourself, really just be mindful of how these numbers will change over time. And that some of that is opportunities, but some of it can be challenging as well. Let's get into our presentation here. All right, I popped off videos so that we can see these numbers. We're going to start out with just getting in a tax mindset. Don't worry, we're going to go into all of this a little bit later in the presentation, but I think it's just a good way to start the conversation of thinking about these kind of tax nuances. So in this example, we have Bill. He's a client of ours and he's retired, and Bill knows what his taxable income is going to be. He's got the numbers drilled down and he has $41,825 of taxable income, which if you see the brackets that we have on the right there, that's going to put him just into that 22% tax bracket. His $41,825 taxable income includes $38,000 of IRA income. We have $25,000 in Social Security benefits. But on top of this, he's actually decided he was going to access another $1,000 from his IRA for a road trip to a concert. He's retired, he's got more time, and he's looking to have a little bit more fun. So he said, you know what? Show I've always wanted to go to. I'm going to go for it, and I'm going to take out an extra $1,000 on top of that 38 that I already planned for. So now he's starting to think about, well, how much tax did I pay on that extra $1,000? So he's thinking to himself, I already know I bumped up in that 22% tax bracket. So every additional dollar that I take out beyond what I'd already planned for, I'm going to owe 22 cents because I'm in a 22% tax bracket. So from his standpoint, he's thinking I took $1,000, so I'm going to owe an additional $220. Well, the challenge is that when he went and getting his taxes done this year, he found out that for his 2022 taxes, he didn't owe the $220 that he anticipated. He actually got a tax bill for $407. So while he was thinking he was going to owe 22%, the number came back over 40%. And he's stuck trying to figure this out. We're going to come back to this and dig into more details, but these are a good example just to start the conversation of how we need to have an understanding of how these retirement pieces all work together so that we don't end up getting caught off guard with the taxes that we owe. One of the things that we talk about with clients a lot is the importance of making sure that we're educated so that there's none of these surprise moments where we look back and say, gosh, I wish I would have known. I might have thought twice about taking additional money from my retirement account, or some other example where it's just, had I known, I would have taken a different course of action. Even without getting into the specifics of this example, it's really just a great kind of segue into that seek professional tax guidance. So as you all know, we are not tax professionals. We partner with tax professionals, so CPAs or tax planners that can help you with those key pieces. If you're doing your own taxes, I also encourage you to periodically have your taxes done by a professional to audit them to make sure that you're coming up with the same numbers. It's a really great checks and balances to ensure that there's not something that you're overlooking. When we're talking today, we're going to talk about retirement. So we're going to be talking about individual retirement accounts. So we're going to take a moment here and specify traditional IRAs. Anytime that we're referencing that, we're saying that these are dollars that have not been taxed. So when money is coming out, we're assuming that it's all going to be taxable, whether it's a distribution or a conversion, and that you're going to owe taxes out of federal, and if state rates apply, the state taxes as well. Roth IRA, that's money that we've already paid taxes on when it went in. So it's growing tax-free. So we're getting tax-free growth, which allows for tax-free distributions, assuming that we meet the IRS rules for that. And then I already referenced state taxes. This presentation, we're really talking about federal, but if you live in a state where there are state taxes, that's another consideration, which can add some complexities. So just keep in mind that the examples that we're using today are really just going to be focused on that federal tax piece. So when we think about retirement and taxes, why are we having this discussion today? A big part of it is that for most of us, we think that we're going to have less income in retirement and therefore less taxes. I hear this time and time again, and it would be fantastic if that was always the case, but in a lot of instances, it is not. So we want to just start to think about, what does our tax picture going to look like in retirement? So first, we're going to think about what are the changes that are happening to going from our working years to our retirement years. So we've gone from saving, we've spent most of our life in this idea of we need to save and accumulate money as much as possible for retirement. But now we're getting to the point where we don't have income coming from an employer. So maybe we're going to be taking distributions or spending down some of that money that we're saving. Another thing that we find is challenging for people is they lose deductions. Mortgage interest is a big one. I've worked really hard to pay off my house. I no longer carry a mortgage balance, or I'm no longer able to make contributions to my 401k or IRA because I don't have earned income. So a lot of these deductions that we had go away, and we want to be thinking about how that's going to impact our overall tax picture. And then we also have additional sources of income and expenses that might be a consideration from a tax standpoint. So Social Security, how is Social Security going to play a role in our retirement income and taxation? Required minimum distributions for those traditional IRAs that we've been deferring all of those taxes in. We reach ages where we have to take those dollars out and they become taxable. What kind of impact does that have on our taxation? Paying for Medicare. It's always a really exciting milestone when we reach age 65 because we're eligible for Medicare, but there's a cost for paying for that, and we want to make sure that we're understanding what's going to trigger us paying higher premiums versus the standard or lowest premium that we can pay. And then long-term care. For many of us, there could be instances in our future where we have high care expenses, and how is the best way to cover those from a tax advantage standpoint, or really tax planning standpoint, where we're thinking not just about our income, but assets that are going to be going to the next generation and could carry some taxation with that. So at this point, people are already starting to think, there's a lot of moving parts. And for those of you that are already in retirement, you've probably experienced some of these. But really, when we're doing planning for new prospects or clients that are coming on board that haven't quite got to retirement, we start to say, where do I begin? And that's really understanding what your financial picture looks like from an after-tax perspective. So for most of us, we've accumulated the majority of our assets by the time that we retire. We have them in different buckets. And some of those buckets could be tax deferred. So that's going to be traditional 401k, traditional IRA, could be annuities. So that's where we haven't paid taxes on all of it. Then we could have some after-tax money. So that's money that's in accounts where we're paying taxes as it's earned. There could be some gains that accumulate in there that will have to be managed. But for the most part, we're not having a lot of taxation in that bucket. And then there's Roth, which is truly after-tax dollars that are growing tax-free. So how do we think about all of these together, and how do we prioritize how much we're having in each bucket? So again, if this is primarily before retirement, we're wanting to think about how much of my dollars are really going to be available to me in retirement. That's where we think about that after-tax piece. So in this example, we're talking about an individual who saved $500,000 in a 401k or IRA. So that's one where they've been getting a deduction every time they're putting that money in. They're not paying taxes on those dollars. So how much of that 500,000 is really going to be available to me in retirement? And that's going to depend on my tax rate. So in the example here, you can just see the difference of, and these are higher tax brackets that we're illustrating, but if I have to pay 35% on those dollars, then really 500,000 is going to only equate to 325,000. Or if I'm in a 37% tax bracket, it's going to be even less at 315,000. So really thinking about this after-tax piece is an important part of the planning component, because we don't want to be over dependent on dollars that aren't really ours because we haven't paid the IRS yet. Another factor that we're hearing more and more about is inflation. And so when we do our projections and illustrations, we not only consider taxation, but also inflation. For our conversation today, we're really just looking at the tax piece and where those dollars can be decreased because of that tax component. But there are other pieces when we do our analysis that we want to be considering. And then in addition to these dollars, since they have not been taxed, the IRS says you're going to have to distribute them at a certain age. And that age has historically been 70 and a half. So for some people on this call, you might already be in a required distribution phase, but it's been inching up. So if you haven't begun your required distributions because you had not reached the required age, in 2023, that age is 73, and it'll remain 73 until 2033 when it becomes 75. So this is just being mindful of, we're growing this tax deferred bucket that we're going to be required to take dollars out of in the future. So it's a tax planning opportunity to say, do we want to wait until that required age is met? Or depending on the rest of our circumstances, does it make sense to take some of those dollars out before that required minimum age so that I can take advantage of lower tax brackets where I haven't started other income sources such as pension or Social Security? And I'll talk about that a little bit later. What we're illustrating in this graph, and hopefully you can see it clearly, is if for an individual who started required distributions at 70 and a half, how much that money is going to cumulatively add up to over their lifetime after taxes. So this is saying I'm processing my required distributions, I'm earning a 6% rate of return on my investments over time. What does that graphically look like after taxes? So the top bar, the gray bar, is showing a 0 tax rate. So that's where we are not owing anything on taxes. So that would really be an instance where it's not in a tax deferred bucket. A Roth account would be an example of that, where we could be saying, great, I'm taking distributions, but I'm not having to pay any taxes on it. And that is going to allow us to have the most dollars over our lifetime. I think that makes sense to everyone. We were going to have, up over $900,000 of distributions without any taxation. Well, how does that $900,000 decrease if we had a 12% tax rate, which is the red line, or 33% tax rate, which is that teal colored line? And so you'll see that the taxes are minimizing those dollars over time, which makes sense. As we said, the IRS hasn't got their piece of the pie yet. So we need to make sure that we're paying taxes on those distributions. So really the work that we can do around planning is to say, I know I'm not going to be able to be in that 0% tax rate, but what can I do that would get me as close to that 12% tax rate as possible, or somewhere in between that 33 and 12%. And that's really the piece that we're looking to help our clients do over time. We want to minimize taxes so that we can maximize dollars in your pocket. So typically when we're doing this type of planning and scenarios, people say, okay, well, I know I had to pay taxes on those dollars. That's expected. I have these other pieces of my financial picture that are going to come into play. So Social Security is going to help to supplement some of my income, and Medicare is going to help to decrease my medical costs. And Medicare is a big one, especially if you retire before age 65 and are paying for personal health insurance. It's a big expense. And so we're saying, yes, I know I'm going to owe some taxes, but I'm going to have some help from these other pieces that are going to help to offset some of those other incomes that I need or decrease some of those expenses. So let's take a closer look at how Social Security and Medicare, while they're great tools for our retirement, there are some challenges from a taxation standpoint in how we want to be mindful of those as we're thinking about this big picture. So we're actually going to go back to that example that I gave in the beginning. So if you recall, this was Bill, and he said, Lindsey, I took an extra $1,000 from my retirement account in 2021, and so I'm doing in 2022, and I'm doing my 2022 taxes. And I don't understand how I got into such a higher tax bracket, or I guess a higher taxable income. So I said, let's break it down and look at these scenarios side by side. So before we took out the $1,000 for that IRA, for the concert from your IRA, we had $38,000 of income distributed from the IRA. Your Social Security benefits are $25,000. That gives your, after standard deductions, your adjusted gross income is going to be roughly 56. So before that, so you take out your standard deductions. Now you have taxable income of $41,825. Income tax on that is $4,819. He said, I get all of that. It's this additional IRA distribution that I took that's causing the confusion. So we look at that, we just say, okay, great, there's 39,000 came out. We still have the same Social Security benefits, but we notice that the adjustable gross income and taxable income both went up by more than $1,000, which is why the income tax is also up more than that $220 that we expected. So let's look at those two pieces specifically, the adjusted gross income and the taxable income. Digging in, he said, I realized the reason why I owe more is because I triggered additional Social Security tax, which he was not expecting. And that's because the complexity of the way that our Social Security benefits are taxed. Most people think that Social Security should not be taxed or is not taxed, but that's not the case. It is tiered as far as how much tax you're going to owe, and your provisional income determines if it's 50% taxable or 85% taxable. So the good news is that it's not going to be 100% taxable. At the very least, you're getting 15% of your Social Security benefits without taxation, but up to 85% of them are taxable. And that's what we saw happen in this case with Bill. His $1,000 distribution triggered an additional $850 of taxable income for Social Security. And so that's why, rather than it being just $1,000 increase, we see it be $1,850 is the difference in his in the taxes that were triggered. So dig a little bit deeper in that and say, okay, great. That's how I got to the difference of that 407 is the taxes that I owe because of that additional 850 that it was triggered. So in this instance, he is still paying the appropriate tax, but it's just that he triggered additional income piece. And so that's where this sort of simplistic example of how we can say, if I'm not already paying 85% on all of my Social Security benefits, these additional distributions can trigger additional taxation, which causes us then to say, it's not as simple as withholding the 22% that I was anticipating. I owe some additional taxes on that piece. These are the brackets for 2022. As I mentioned, they're the sheet that I shared in the chat has on the back page the income brackets for 2023. So in this instance, he's a single filer. We would see that those brackets would go up just slightly. But again, when we're thinking about these pieces, understanding how much taxation is occurring in these different buckets is really helpful so that we're not thinking about them just in single pieces. We need to think about them together. Medicare is another place where people sometimes get surprised, and that's because the brackets for Medicare premiums are different than they are for income. So these are the pieces when we're thinking about it's income. It's the income that triggers additional premiums. So we want to think about IRMAA, which for a lot of people, they say, I've never even heard of this before. If you're not Medicare eligible, you probably haven't, but it's income related monthly adjustment amount. So we're going to go through an example of how additional taxes can trigger, even a small amount can trigger higher Medicare premiums and what that looks like. So in this example, we're looking at George and Martha. They are over 65. They have Medicare Parts B and D. They have a modified adjusted gross income. This is back in 2020. So an important thing to think about for Medicare premiums is that it looks back 2 years. So your 2022 Medicare premiums are actually based off of your 2020 tax return. It's another reason why this can catch people off guard, because it happened 2 years ago and you forgot all about it. And now here we are, and it's coming back to the surface. So in 2020, they sold stock for a gain of $1,000. At the time, they thought the stock's been doing well. We want to sell it, realize those gains, put it in our pocket, and we're not going to have to pay that much because we're going to owe 15% for long-term capital gains rate. That's the 150 that we see. And then because they have income over 250,000, they also had a net investment income tax of 3.8. That's where we get the $38. So they're selling stock and they're gaining 1,000, but they're going to owe $188 on it is what they calculated. So they're saying, great, we paid 18.8% on that capital gain. Well, 2 years go by and they're realizing when 2022 rolls around that they were going to have to pay higher Medicare premiums. So if you remember on the previous slide, we said that their income was $283,500. So they were just $500 away from that next threshold of the IRMAA charge. And so rather than paying $340 in their Medicare premiums in 2022, they actually had to pay $442 per person for all of 2022. So there was about $200 a month more that they were having to pay for their Medicare premiums because of that $500 bump that pushed them up into the next bracket. Not only did they have to pay more for their Medicare Part B, but they also had to pay more for their Medicare Part D. And while the premiums for that went up an additional $39 a month. So we'll see here, this is a summary of the 1 year change that stock sale actually triggered. So for each of them, they're having to pay an additional monthly charge for Part B and Part D. And that combined over the course of the year is almost $3,000 of additional charges because of that new threshold that they got into for IRMAA. So again, just taking a quick recap of what that looks like. They sold stock that was triggered $1,000 of income gain. The tax on that was only $188. Part of the reason why they thought not that big of a deal to increase, but that triggered that next income tier for IRMAA, which was roughly that additional $2,900. So the combination of all of that is they had $1,000 of extra income, but it triggered taxes and charges of over $3,000. So this is a very simple example of just barely going up over that tier. But we see this happen a lot when people sell larger appreciated stock, property, including your own home. A lot of people don't know or don't consider if they want to downsize in retirement, that they could trigger going up into a higher threshold with the sale of their primary residence. Because while you do get an amount that you don't have to pay those long-term capital gains on, anything in excess of that will be taxable and gets added to this picture. And so it's really important when we think about planning for big transitions or sales that could cause taxation, how that's going to impact us down the road. And so the numbers we were looking at before were for 2022. Our 2023 IRMAA bracket, so this is the premiums that people are paying this year, were based off of modified adjusted income for 2021. So I share this just so that you can see current numbers, but also to be thinking about the fact that these are delayed 2 years. So a lot of the planning that we try to do, for instance, at the end of last year, we were doing 2022 planning. That's going to impact our 2024 Medicare premiums, and we don't know what those brackets are yet. So we're basing it off the information that we have available, but these income amounts do tend to increase every year. So that gives a little bit of buffer space. But again, if you have a one-time property sale or large stock appreciation that's going to push you up into some of these higher income brackets, just be mindful that it's going to increase your Medicare premiums for 1 year. The good news is that it is only for a single year. And so it does fall off, but the challenge is, like I said, it's 2 years after you file that you see that increase change. So a lot of people tend to kind of have forgotten about that one-time bump in income until these Medicare premiums roll around 2 years later. Another thing that we really want to be mindful of as far as additional costs. So these are examples of, not necessarily taxes that are triggered, but additional costs that are triggered is when we enroll in Medicare. So if you're 65, you're eligible for Medicare and you need to enroll unless you have coverage under an employer plan. And if you have coverage under an employer plan, then you have until you retire to enroll in Medicare. But if you delay retiring, then you'll actually could be instances where you have a gap in coverage, but you're also going to get hit with a late enrollment penalty. So this is an example of if you waited and didn't necessarily enroll as soon as you retired, then you have an instance where you're going to have a lifetime penalty of 10% a year in your Medicare premiums. So this is an example that you'll see of what the base Medicare premiums are for 2023. So $164.90 is the base. If you multiply that by 10%, that's an additional $1,649 per month. And then if you are just under $200, and if you're a couple, that's times 2. So this couple in this example are going to have to pay almost $400 more a year for their Medicare premiums for the rest of their life. And this assumes that they're in the lowest coverage. If they were having to pay higher premiums, then that could obviously be even more costly. So this is just a reminder that we really want to be mindful of that age 65. And once we're eligible, making sure that we are applying for Medicare premiums. So we are Medicare coverage, even if it doesn't happen instantly, because if we delay, there's going to be an extra cost. And the reason why, even if you have coverage in retirement, which is what this example said, we're retired and we still have coverage through our previous employer, that coverage is typically secondary. So Medicare will pay first, and then that employer coverage comes in as a secondary coverage piece. So we really want to make sure that we're making that application for age 65 for Medicare. So usually we're starting to think about, okay, some of these things I've heard, some of these things I knew, is there anything else that I really need to be mindful of as I'm planning for pieces of my retirement picture? We talked about this early on in the webinar, but really how to use the different assets that you have is a really important planning piece. For most people, they think I want to wait and touch my tax-deferred assets last. So that means those retirement dollars that I have to take at, maybe it was 70.5 for you, or maybe it's 73 is going to be your future date, or potentially 75. I want to touch those dollars last, and I'm going to spend down some of my other monies first. But that's not always the best plan, especially if you're in a really low tax bracket for the first part of your retirement. So we see that with people who retire early and they have not started Social Security, they have not started pension benefits, so they effectively don't have any taxable income. getting some money out of those tax deferred buckets in those lowest income tax years is going to be the most advantageous strategy. And it's very counterintuitive to people because we are taught that our retirement dollars are the very last ones to touch, but really it creates a planning opportunity. And so we think about the graph that I showed earlier where we had that zero tax was the highest bar, and that was the one that was going to give us the most dollar amount. So most people come to me and they say, great, I get now that Roth dollars are really beneficial. I didn't know or understand soon enough that I should be putting more into that bucket. Maybe it wasn't even available during, some of the earning years where I was really plugging it away. But now I want to know if there's an option for me to get more into that tax-free bucket, which means I pay tax on it now, and that continues to grow tax-free. So this is an example of Jill wants to convert $100,000 from her IRA to her Roth IRA. If we did that all at once, that would add $100,000 to her income. And depending on where she's at in this retirement timeline, that could have some domino consequences. Let's just say that she was already, in a high bracket, and so it's going to cause her to have higher get into a higher IRMAA tier, and so she's going to have to pay higher Medicare premiums. Or there's things that we just want to be mindful of. Not only do we want to be thinking about her individual tax rate, but these other pieces of the puzzle. So we come up with a strategy to say, what if we did that over time? And so this is graphically a way for us to think about different tax brackets. And so we could say for Jill, she's already got 10% bucket full. She's already got her 12% tax tier full. She hasn't filled up that 22% bracket yet. And so we have some room where we could convert the dollar amount from where she's currently at in that 22% bracket all the way up to the top of that bracket. So we want to fill as much of that bucket as possible and not leave it with part of it empty. The reason why this is important is because, one, her objective is to get money out of her taxable bucket and get more into that tax-free bucket. But also, if she hasn't triggered all of her other incomes, we can already anticipate she's going to be in a higher tax bracket down the road. So we know in the future she's going to be in a 24% bracket. And so we wouldn't want to not take advantage of that 22% while she's in it. We might even consider doing some of the 24 if that's where we know she's going to be in the future anyways. So thinking about this bucket strategy has been really helpful to clients to say, how can I maximize some of my dollars by taking advantage of these lower tax brackets while I'm in them, if I anticipate being in higher tax brackets in the future? And again, what's going to drive us into higher tax brackets? Those required distributions could, the Social Security benefits that you haven't started, if you have pension that you haven't started, but also expiring tax laws. It's really important to note that our current tax laws are set to expire at the end of 2025, and a lot of the existing tax brackets are going to move up. 12% is going to go to 15. 22 is going to be broken out. Part of it will go to 25 and part of it will go to 28. That's a pretty big jump for the part that's going to go from 22 to 28. That's a 6% increase. Same thing is true for the 24%. It's getting broken up into 28 and 33. That's a big tax jump. Part of that's going to go up 9%. If the current tax laws, they are set to expire at the end of 2025. So in 2026, they would revert back unless some other tax law is enacted. So these are really important things for us to be thinking about, these windows of opportunity to say, how can I take advantage of these tax brackets or buckets that I know I'm going to be in for the next few years with the anticipation of being in higher tax brackets in the future. Other things that we want to consider when we're looking to manage tax brackets: withdrawing tax-free money from life insurance policies. That's where we take loans. If you have an old life insurance policy that has a high cash value in it, you can take loans from that policy. That is not taxable income. Selling a highly appreciated stock for low or no capital gains, that's a tax planning piece. That means we have to realize losses in other cases where we can use that to offset some of that appreciation. Taking distributions from IRAs or 401ks to take advantage of a lower tax rate. This is one that I mentioned just a minute ago where I've retired early. I'm 59 and a half, and I have $300,000 in savings that I'm planning to use to supplement my income until I start Social Security down the road. That might not be the most advantageous tax play because you effectively have no taxable income until you start that Social Security in this example. And so if we can take money out of that IRA bucket or 401k bucket, the tax deferred bucket, and only be paying 12%, even 20% on those tax dollars, that can be a really good planning opportunity when we think about the rest of your retirement years. So a lot of times we see that the kicking the can down the road from a tax standpoint on these tax deferred vehicles, but they just continue to balloon up and become bigger and bigger. And so we want to make sure that we're not going to get stuck in a situation 5 years, 10 years down the road where we say, gosh, I wish I would have taken more money out sooner had I known. So again, our job is to help educate you to understand your scenario and how we can help maximize dollars. In some instances, minimizing taxes is the way that we can do that so that we don't run into a situation where we look back and say, gosh, it would have been helpful to have considered that sooner. If you haven't retired, so for those of you on the call that are still working, a health savings account is a great tax saving tool because you get a tax deduction for the money that goes in there. It grows tax free and you get to take it out without any taxes. So this is kind of better than a Roth from a standpoint of as long as it's for covering healthcare costs, there really is no taxes on those dollars. So that is a really great benefit. And then if you are a business owner, there's a qualified business income deduction that you could be using to help minimize taxation during those working years. Another way that we can take advantage of some minimizing taxes are for people that are charitably inclined. We can do that directly from your tax deferred retirement account. So we see this question asked a lot. It's something that people may have heard of, but maybe don't necessarily fully understand. So I wanted to take a minute to just kind of dig in a little bit to understand how these qualified charitable distributions is what they call work. So in this example, we have Albert and Shirley. They're in a 24% tax bracket. Part of their annual planning is that they give $5,000 to charity. They have $15,000 in itemized deductions. And in 2023, the standard deduction is $30,700 for people that are 65 and older that are married. So we know that that's going to be the option they're going to use because their itemized deductions are only $15,000, and their $5,000 donation in that instance isn't going to get a tax benefit because we've already used the standard deduction. So we're going to talk about how a qualified charitable distribution is going to make sense for their specific circumstances. But before we dig into that, I just want to make sure that we take a step back and understand what this qualified charitable distribution means. So it allows individuals that are 70 and a half, that age remains the same, even though 70 and a half changed for required minimum distributions. It is the same for qualified charitable. The qualified charitable distributions are 70 and a half, where RMDs have increased, where you have to be older. That increase or age change did not apply to the qualified charitable distribution. It allows you to distribute up to $100,000 from a IRA directly to a charity. That piece is key, directly to the charity, and it does not count as taxable income, but can count as your RMD. So let's see what that looks like specifically. In example one, this is what they've been doing before understanding the qualified charitable distribution. They want to gift $5,000 to charity. They take $5,000 as their RMD. That goes from their IRA to their checking account. It gets reported as taxable income. They get a 1099 at the end of the year that says you took out $5,000 from your IRA. They're in a 24% tax bracket we already established. So that means that they have to pay taxes of $1,200 on that $5,000. So while they gifted $5,000 to the charity, it actually cost them $6,200. So that's the amount that they would have to take out before taxes in order to net $5,000 to go to the charity. So how does a qualified charitable contribution differ? It differs in that the money goes directly from the IRA to the charity. So you cannot take receipt of the money in the middle. So what we do is we say, great, give us the name of the charity that the money is going to go to. We have a check made payable to the charity directly from the IRA. It gets sent to the charity notes the contribution from you. But since it flowed to the charity directly and not through your bank account, it is not considered a taxable distribution, but it does satisfy the $5,000 required minimum distribution. So in this case, you took out $5,000, the charity got $5,000, and you didn't owe any taxes. So you saved effectively $1,200 in tax savings. And that one I want to just pause on because I think people are always curious about it and sometimes just say, I want to understand how it works a little bit better. The biggest things to note is that if it's going to be to satisfy your RMD, we want to process that before any other distributions. And then it does need to go directly to the charity. So it's just that piece of making sure that the money doesn't go to you that avoids the taxation. So we've been thinking about ways where we can continue to maximize dollars by minimizing some of these taxes. And a really important consideration is taxation from one generation to another. And so this is a conversation that we're having more and more with clients because they know that dollars they don't pay taxes on during their lifetime are going to be taxed when they go to their children. And so this is legacy planning. So it's really saying for dollars I don't need or I'm not going to use during my lifetime, what are options that I can do that are going to really enable them to be passed on more tax efficiently to the next generation? And part of the reason why this has become increasingly a bigger conversation piece is because the tax laws changed as far as retirement dollars that are inherited. So if you inherit retirement dollars, you now have to distribute them over a 10-year time period. Previously, you could distribute them over your lifetime. And what that did is that allowed you to spread, as a beneficiary inheriting money, to spread those taxes over a longer period of time. Now, as a beneficiary inheriting them, you only have 10 years to distribute them. And if you think about when we most frequently inherit dollars, it tends to be in our highest earning years. So if we're in our late working years, we still have income coming from our job. But even if we've already retired, we've already figured out our retirement income, not banking on money coming from an inheritance. And so if we already have our tax plan in place for our own assets, and then we inherit a bunch of taxable assets, it can really cause the taxation piece to erode the value of those dollars. So it's a much more complex planning piece than it used to be, and something that we want to continue to be having more in-depth conversations with you about so that we can make sure that those dollars are being maximized, not just for you during your lifetime, but for the next generation that may be inheriting them as well. Long-term care is a piece that comes up a lot in this discussion because for most people, we're earmarking that sort of bucket of money that's anticipated to be left at the end of their life to be for long-term care costs. And that could be in conjunction with a long-term care policy. So for people who are not self-funding means I'm just having my own assets and I'm going to use them for long-term care if I need it. A lot of individuals have long-term care policies. And so we get into a challenging situation where we say, okay, I've paid for this long-term care insurance. I have benefits that I can access from this. Does it make sense for me to access these benefits versus spending down my own dollars? And how do I know what's going to be most advantageous to me and to my beneficiaries? So these are hybrid policies is what they're typically called. So they are long-term care policies that have life insurance components to them. That means if you don't use the long-term care benefits for your care, then there's a death benefit or a life insurance benefit that goes to your children. So in this example, we're looking at Florence, and she is in full-time care. She's receiving at-home care, but full-time. And she qualifies for benefits. Her benefits are $6,000 a year. Outside of that, she has $20,000 in Social Security benefits, and she has an IRA of $400,000. So the piece that we're looking at is her long-term care insurance, which is either can provide that $10,000 a month for long-term care costs, which would, she could get enough to cover the $60,000 a year that she needs, or leaves a $500,000 death benefit to her children. So let's look at scenario one. So in the first case, she's saying, I have no taxable income for the first 5 years because of my high medical expenses. Her long-term care insurance pays for the benefits that she's receiving in home. Remember, it said that she could get up to $10,000 a month. She's not needing that amount. She's getting $60,000 a year for $300,000. So she uses those benefits. Of the 500, she uses 300 to cover her care. That means when she passes away, her children will inherit the life insurance, which is tax-free, of $200,000, and her retirement account, which of $400,000, which is taxable. The other scenario is that since she doesn't have income tax because of her high care costs that are deductible, she's going to use some of her IRA money to pay. So she uses $300,000 of her $400,000 to pay for her care. In this instance, the kids are going to inherit $500,000 tax-free, and they still get $100,000 from the remaining IRA funds. So the total dollar amount that they receive is the same, but because less is taxable in this scenario, 100 is taxable versus 400 in the other scenario, they actually inherit more after-tax dollars. So this is an example where we can look at the individual circumstances and say, because she was in such a low tax bracket, it potentially made sense for her to not take the benefits and you spend down her own taxable money because she wasn't having to pay taxes on it, which enables the beneficiaries to get more money after tax than using the benefits. That's in this particular example. That's not always going to make the most sense, but this is really to illustrate that it's not a given that one solution makes the most sense in every situation. So we really need to be looking at everyone's individual financial picture to help make a decision about what's going to be most advantageous for their needs in their tax circumstances. This is where we say, okay, this has been a lot of good information. Hopefully you're starting to think of some things that might apply to your own circumstances and how this information might be beneficial to you looking at your planning. If you have questions on anything that's come up that would be good for us to address together, I would love for you to start putting those in the question and answer box. If you have questions about your own specific circumstances, we encourage you to reach out and schedule a one-on-one discussion. But really, we just wanted to say that there are opportunities throughout all of retirement where we want to be thinking about this tax piece. So it's not just thinking about it at one stage, it's really thinking about it all the way through. So for pre-retirement, we want to know what our after-tax savings looks like before retiring. And if you are still working, we want to be thinking about, should we be contributing more to that Roth or after-tax bucket versus tax-deferred? And for a lot of people, I already mentioned it, I hear so frequently, I wish I would have done more in that bucket earlier. And we still have the opportunity to talk about conversions. So that's to say it's not too late, but I really want to make sure that you're sending that message on to others in your life. So children or grandchildren, people that are earning and saving for retirement that still have a long time before they reach that milestone. The more money they can get into that bucket, the more that they're going to have that tax-free growth, and they're not going to have as much challenges with having to manage these tax pieces in retirement. Early retirement, if you are retiring before starting some of those other income sources, we really want to take advantage of those low income years and figure out how to fill those buckets up to the top, whatever tax bucket we're looking to fill. And so there's a lot of planning that can go around that. Once we get to that 73 to 75 age range where we're having to take RMDs, we really want to be mindful of how are we doing that efficiently? If we're making charitable contributions, should we be doing that directly from our IRA rather than having the money flow through us? And then again, even thinking about middle retirement, should we be shifting some of those distributions to early retirement rather than waiting until they trigger in middle retirement? And then as we get later into retirement, for a lot of people, it becomes more clear what they're going to need for themselves in retirement. And then we start to think about that legacy or estate planning side of things. So what is the piece that I really want to be leaving behind, and how do I do that in a tax efficient manner is the part that we start to think of for that end of the piece. And then we really just want to make sure that we're thinking about how all of these pieces come together. Like I said, the reason why we're having this conversation is because all too frequently people think they'll be in a lower tax bracket in retirement than they are. And so we really want to make sure that we're going in eyes wide open and understanding the full financial picture and when some of these different challenges can be triggered, and are there ways that we can minimize taxes, which helps us maximize those dollars more. It changes every year, so we want to be thinking about too, are we revisiting these tax numbers? What are we doing that are going to help us be thinking about where we're going to be a year from now, 2 years from now? And if we have anticipated large tax events such as sale of real estate, highly appreciated stock, how are we planning that? And is that something that we can take advantage of other tax planning opportunities? And then I hit it on it again, but just to close it out, we want to think about those years that we're in the lowest tax bracket. It always feels good to just be sitting in a low tax bracket, but there's really an opportunity to take advantage rather than just say this is the least amount of taxes I've ever paid in my life. This is great because we know we're going to be having to pay more taxes in the future when we have Social Security, required minimum distributions, and other taxations that occur. We did have some other, just like I said, we already know we're going to be in a distribution phase following accumulation. So how do we manage that? And then kicking the can down the road, I referenced it a couple of times, but we know the taxes are going to be a reality of our circumstances. And so let's make sure that we're being mindful of how to manage it versus just have it continue to balloon up. Some of the mistakes can be costly. The Medicare premiums one is probably the one that is the most as far as delaying, meaning not enrolling right away and having those ongoing costs. Otherwise, we can deal with planning around a one-time or 1 year increase in Medicare premiums. That's not something that's going to be an ongoing challenge, but really it's just about making sure that we're educated, understand our circumstances, and are working with professionals in tax planning, in a tax filing if we need for our own individual circumstances. And then we did have a question come up. So discussion of taxation on the first to die when surviving spouse is in the single tax bracket rates the year after the spouse dies. There's little reduction in income other than Social Security of the lower rate. So I think what the question that we're asking there is just how do we tax plan for going from two individuals to a single individual. And unfortunately, we do find in a lot of those circumstances that the taxes do not end up being less. They can end up being more, because while you are losing an income, in that instance, as it was said in the question, there is a single Social Security income loss, but you're also losing the deduction on the other side. So there is some tax, strategy considerations that we make once we're going from a married couple to a single couple. But unfortunately, as I said, there are kind of some challenges around the income or the taxes being higher versus lower. One of the things that we didn't talk about as far as planning once we get to that sort of end of or closer to the end of life is gifting. How do we get more dollars out of our estate while we're still living versus waiting until the end? And there are annual gifting amounts that you can gift without triggering additional taxes or having to file a tax return for your lifetime gift amount. So that's something else that we talk about. You can do annual gifting to family members. You don't get a deduction like you do for charity, but that's another thing that we like to talk about when we're thinking about that end of life planning piece. And then really, I'm going to close with just annual tax planning. This is a conversation that we want to be looking at, each year before the end of the year. Typically things come up and people are asking questions about taxes now, and it's a little too late to be doing anything for 2022. We can definitely be talking about planning for 2023, but if you have any circumstances or pieces of your own tax life that you want to revisit or explore for this tax year or future tax years, we definitely want to have that be part of our annual discussion. And I'll reiterate that I do think it is helpful that if you are doing your own taxes, to every so often have them professionally done, so that you can make sure that there isn't anything that you're overlooking or pieces that you might have missed that could help improve your overall tax situation. And then really pay attention when we send out our annual key financial data sheet. That is a lot of information that can be helpful. So if you do want a copy of that and have not received it, please let me know. And if you have anything that's really kind of top of mind as we were going through this conversation that you said, I really want to understand how that impacts my own financial circumstances, I would love for you to reach out. We can schedule a follow-up conversation. I realize that it can be challenging when so much of this information is generic. So if you'd like to talk about your specific tax circumstances, myself and the team are here for that conversation. But with that, I'll hope that everyone is close to completing their 2022 taxes and that there were no tax surprises for them. And look forward to having conversations with all of you about your 2023 taxes and beyond.